just to get a sense from a third-party independent thinker. Nanette has been in the investment business since the 80s. She's been working at Wellington for the past 15 years as really one of the faces of Wellington, and speaks about investment topics and the economy all the time. So she's very astute at doing this. One of the things people don't know about Wellington right off the bat is that they're the sub-advisor for Vanguard. So Vanguard, being one of the largest fund families, money management companies in the world, will look to Wellington for managing, I think it's about 10 of their funds, I can't remember, but somewhere in that range. And also manages 100% of the Hartford funds. So if a firm is looking for world-class investment management, they might say to themselves, well, besides us, what other organizations out there do this for institutions? And Wellington has been doing it for over 60 years. One of the things about their culture, one of the things I find interesting about Wellington is that they have every morning an investment meeting called the Wellington Morning Meeting, and hundreds of professionals from all over the world get on this call to talk about what's going on, their ideas, and they also challenge each other. And the thing about investing, I've said, what I say is if the perfect portfolio is one you never changed, because your judgment was so good up front, you never needed to change it. But of course, no matter how good somebody is, they make investments that they wish they hadn't. But with the morning meeting, they talk, in a way where they collaborate, but they also challenge each other. And I really like that. And I think on our team, I promote the same ideas instead of just everybody agreeing with everybody. Let's challenge the way we think about things. So anyway, with that, you all know Chad Hamilton. He's our Director of Client Services and Practice Management at Brown & Company. And he will do the moderating today. I'm going to get off camera and go on mute while the presentation goes on, and I'll come back to say goodbye at the end. Thank you very much.
Thanks, Mark. So, Nanette, we'll start with the big picture, your views of the markets and the economy at large, and then a little later on, we'll dive deeper and get into thoughts on different sectors and industries as it pertains to the election next week. And so let's actually start with your outlook on the bond market, and kind of a twofold question. First, what are your feelings on credit? And then second, what areas of fixed income do you like most?
Sure. Well, thank you, Chad. Thank you, Mark. Really appreciate being here. And thanks everyone for taking some time out of your schedule. Hopefully we can, oh, this is great. Super, we even have slides, wonderful. Okay, so I don't have a dog, but I do have a teenager. So that could also present interruptions. So, but hopefully we won't have any hiccups along the way. Okay, so the fixed income markets, obviously it's very challenging right now because all over the world, we are at near zero yields, which is what this chart is showing. Whether you look at Europe, Germany, Japan, Italy, or the United States, in real yield terms, we're actually at negative yields. So it doesn't seem like a very appealing option to be in fixed income, at least in the risk-free assets of government bonds. That said, I think you always have to remember what role fixed income is playing. I still think fixed income plays an important role in portfolios because it is still, even at these rock bottom yields, it is still a diversifier in an equity sell-off. So when equities go down, you can expect bonds to go up. There have been a couple of exceptions, but they've been very short-lived. So the extent to which yields prices go up in the bond markets, though, is much less than it had been because yields are so low. So moving to your next question, what are the alternatives to straight government bonds? One of them is credit. And the credit markets are, and I don't know that, yeah, we can stay here. The credit markets are at spreads that are average levels relative to history. They got extremely cheap at the end of March when we saw the low in equity markets. And they have been consistently tightening, but we're still at average spread levels. So remember, spread is the extra yield that you get over government bond yields. So I find that certain areas of the market, and this is actually showing the high yield market in light blue, these are total returns of the high yield market since 2005. And on top of that, it's something called fallen angels. So these are bonds that have been downgraded by the rating agencies and have fallen into the high yield index. And what you see is that high yield managers, if they're investing in fallen angels, they get this extra bump of spread tightening. So high yield looks attractive. There are other areas of the credit markets that take advantage of the housing, the healthy residential housing markets, and that's in securitized assets. And I just want to remind everyone that the Federal Reserve has really adopted the motto of the ECB, former ECB president, will do whatever it takes. And by that, Chairman Powell means that not only are we going to create all these lending programs, but we're also going to expand our asset purchases beyond treasuries and mortgages into the credit markets. So if you look at their commitment to credit, they would purchase up to 40% of the entire credit market. So I feel that credit is very well supported by the Fed, who in a way has effectively upgraded the entire credit market. Now, they're buying high yield, they're buying investment grade corporates, they do not buy securitized assets, but a good portion of the credit markets they are purchasing.
Makes sense. And by the way, with the slides, we have a few that if they help, tee up some of the things you want to say, great, but definitely don't feel like you need to speak to the slides, or if you want me to move to something else, I can do that.
Okay, great.
So when it comes to the equity markets, let's start with this. What is your most non-consensus view? In other words, if we were to hear the perspectives of other market strategists, where would you tend to differ more and kind of have a little bit different take?
Yeah, sure. So for a long time, Chad, I've been recommending US equities over non-US equities. And I would say that has been my biggest non-consensus view. So US equities persistently outperform. And even this year, when we got the CARES Act, which was $2.2 trillion of stimulus, that's when most of my counterparts were saying, we're finally going to have international stocks outperform, value's going to outperform, and basically all the types of trades that I would call value-oriented styles of asset performance. When I say that, what I mean is that value tends to be more cyclical, the more cyclical types of trades. The US is a less cyclical market because they're less dependent on exports to the rest of the world, whereas Europe and Japan are very export focused. So in that way, the US in a slow growth cycle or slowing cycle of the globe, the US is going to outperform, which is what has happened. So I would say that my non-consensus view continues to be overweight US relative to international equities, and also stay overweight growth versus value. Again, my counterparts really started to hop on the value bandwagon, saying, mean reversion will work again. We're at the 10th year. It's time itself should make value outperform. But and we can go into this. I think you really need a catalyst to get value to outperform. And remember, what is value? It's energy and financials mostly. So now it could be, if we do get a giant stimulus package, if we get a blue wave in the election, then we might see value begin to outperform. But I still think for the long run, and I'm talking about beyond 12 months, I think that growth will be a persistent outperformer, and U.S. equities are going to continue to be well placed because 25% of the market is in areas, technology being the biggest, where earnings are still increasing. You've got good free cash flow, good balance sheets, and it's clearly, I think we know from COVID-19, that sector is the winner of the future.
Yeah, well, we're on the same page. We've been overweight to large U.S. growth companies for several years, but especially this year, early this year, we really accelerated that large growth weighting. And the thinking being that we believe the largest technology companies in particular, but just the mega caps more broadly, have brand recognition, access to capital, and staying power to sustain through this downturn, regardless of how long the COVID-19 uncertainty and disruption lasts. So that's the idea. Unfortunately, it has borne itself out thus far. Now, the overweight to large growth and tech in particular, even though it served us well, the question that arises a lot of times has to do with valuation. And so I think it's a fair question at this point to ask you, is tech overvalued now? And are we even seeing some sort of bubble in tech stocks?
Yeah. No, so, great. We have the appropriate slide too.
Work this time.
Yes. So there are two things to say. First of all, I don't think we're in a bubble in tech. Yes, there are, where is the forward PE ratio? It's about 31 times, certainly relative to the late 90s when PEs were 60s, 70s, 80s. We're not anywhere near that. I also think you have to put valuations in context of where competing assets are trading. And the competing assets are treasuries at 80 basis points. So when we talk about equity risk premium, that is risk premium relative to the risk-free asset or other assets. I don't think you can look at valuations in a vacuum. So I see valuations very much hinging on low rates. And when we look at valuations relative to rates, we find that the premium is actually larger than normal. It's around 4 percentage points, which is in the 75th percentile. So I think rates are very important here. And what I would caution is if we are in a year in 2021 of massive stimulus, and that causes rates to rise, it's not my base case, but it is definitely a risk. If interest rates rise, I do think that's been one of the pillars of support for tech. And that's where you could see tech underperforming. I don't think negative returns, but I think it could certainly underperform more cyclical or value-oriented stocks. Let me just see what we're looking at in this slide is the difference between, so we're, again, looking in context, the PE ratio of the tech market relative to the appreciation in the tech index. And if we were to find the plug that makes up that difference, it's earnings. So the point is that that gap is because earnings have exceeded expectations. And as you said, Chad, this is an area, and we see it, the spotlight on these trends only exacerbated by COVID-19, which is the demand for data, the demand for a cloud, computing power, e-commerce, et cetera, et cetera. So what I suggest to clients is that there is a case to take some profits in tech. I would still stay overweight, but I would take some profits, and I would find those companies that are more cyclical and being powered by technology. So they're not tech companies per se, but the robustness of their business models, the future of their earnings capacity and growth are being driven by technology. And I can find great companies in retail. I can find great companies in the financial sector, in transport, and other industrials that are really upping their game because of technology.
Right. Okay. So let's talk about inflation for a minute, because we're going there maybe a bit, or hinting at it. And just this morning, some analysts from Goldman were warning about inflation risk. I think, based on what I've heard you say in recent talks and in a recent white paper, that you're not anticipating a rise in inflation in the near term. So first of all, is that a fair assessment of your view? And if so, what's your thought process on the inflation question, at least in the short term?
Yes, so I think that it's absolutely fair, Chad. I have not hopped onto the inflation bandwagon that many on Wall Street are saying. They're concerned that as the probability or possibility of the blue wave comes, that spending is just going to be out of control, unleashed, and that that will cause broad-based inflation to spike up again. And I think that there are reasons to temper that view, to think that inflation will stay low. Of course, the Fed certainly is of that mind. They talk about the structural changes in the economy. We were at 3.5% unemployment rate pre-COVID, and there was no inflation. And so, the Fed has been on this quest to figure out, how do you prop up inflation and avoid deflation? They feel that's the bigger risk. So where am I on this issue? I do think that there are structural issues, particularly demographics, that and technology, which are suppressing interest rates. And of course, the elephant in the room is that the Federal Reserve and other central banks around the globe are going to be, I think, supporting the markets and keeping interest rates low, because that's really what we're concerned about here, is our interest rates going to spike, which would be very damaging to markets. I just don't see that risk, at least over the next 12 months or so, because for one thing, we're in weak growth. We're looking at -4% growth in the United States this year. Next year, still, the IMF just published global growth estimates. They're still very low. And so growth is going to be the main determinant. There's nothing that I can see over the next year that suggests booming growth that is going to cause inflation. So that's the first part. And the second part is the demographics. Our workforce is not expanding. We've got retirees. We do have the millennials starting to bump up and become part of the workforce, but at the same time, the birth rate is going down. Typical of recessions is for birth rates to drop, and that's what we're seeing. We don't have an immigration policy that would expand our workforce. So generally, I see, growth, but very modest growth. And in that environment, it just doesn't seem to me that the primary risk is inflation. It might be, some years down the line, but I think right now, all the policy that's been unleashed is really meant to prevent the downturn from becoming deeper. And that is a disinflationary environment, not an inflationary environment.
Thanks. Yeah, that's helpful. And I think we can go deeper there, but I think for purposes of time, we'll switch gears a little bit and get back to kind of the matter at hand, the topic of the day. So when we think about the election, and not from the standpoint of trying to forecast or predict the results, but really in terms of just considering economic and market implications of various outcomes, at least maybe three most likely outcomes. You've mentioned these three. We have them just a synopsis here on the slides. You don't necessarily need to get into the slides, or you could kind of, if there's anything there that's helpful, but just can you give us a broad-based perspective and walk us through each of these three scenarios and some of the things we might be thinking about in each of them?
Yes, sure. And Chad, I want to share with the audience that today's market, I know everyone is probably seeing the declines in stocks. What's causing that? I mean, what's causing it is the economic fundamentals. It's the fact that it looks like we're entering a second wave of COVID, tragically, in the United States. There are concerns about growth slowing, and at the same time, stimulus is stuck in Congress. So if there's any message I want to get across, it's that the election, yes, there are near-term risks, there are market reactions. I have found in my career that ultimately the fundamentals and policy will overwhelm, as market drivers, the election results. Clearly, we're in unprecedented times, and the range of outcomes, we can talk about some scenarios that would really be highly uncertain. But I still think the most important thing to keep your eye on for markets is ultimately how the progression of the disease goes, how vaccines go, and then what policy support is in place. And that's why, over 12 months, those are the three things that I'm focused on. And that gives me I'd say cautiously optimistic view on risk assets, because vaccines, treatment is progressing, at least in the right direction. We got to get over this, difficult period over the next few months. And I think support will be there. So now to the election. So I think, we'll boil it down to three scenarios. We have and this is all assuming that we have an election result on November 3rd, which is highly unlikely because we know, depending on what, the new court case for Pennsylvania, how that turns out, we know that the votes are going to be counted beyond November 3rd. So it will probably take, a few days for us, if not longer, for us to get the results. Okay, so what can we boil that down into? So one scenario is a Trump status quo. The second scenario is a Biden win with a split Congress. And the third scenario is a blue wave where Biden wins and Senate control flips to Democrats. And I think that, what I would say is well, let's go through some of the highlights. So with a Trump status quo, with each of these scenarios, there are positives and negatives. And that's why I actually think that the actual election outcome may not be that dramatic for markets, because there are pluses and minuses for each scenario. For Trump, the plus is lower taxes and less regulation. But the minus is that on trade policy and geopolitical risks, just the uncertainty and the really hit to growth that we witnessed in 2019 because of tariffs, et cetera, gives you a two-sided picture. If the results are status quo, I think it could be moderately positive. And I do think in that case, more value-oriented sectors would be winners, and that would be retail, travel, materials, things that are much more cyclical. And I included defense there as well because, with Trump's approach, I think actually this could be the case for Democrats too. The geopolitical risks are higher than ever, and particularly U.S.-China relations are really at a nadir. And, because of much more, I'd say, unilateralism and protectionist instincts all over the world, defense is a natural beneficiary. And then the losers would be, of course, a more protectionist policy would not be good for global trade. Anything related to renewables or a climate policy would also be losers. Moving to the second scenario with a Biden win and a split Congress, it's going to be very difficult for, again, the negative is higher taxes, more regulation. The positive is increased spending. I think some package would go through at that point, and a more predictable trade or tariff outlook. So I put that at unchanged to moderately negative, thinking that taxes and regulation would tip the scales more negatively for markets. And in that case, I think that renewables, transport, materials, municipal bonds, because, for our audience, I think, there's certainly one thing, as Mark Twain said, that you can rely on, which is higher taxes. So with a Biden presidency and certainly with a blue wave. So munis are really important to asset allocation for individuals. And then the losers in that scenario, I think, would tend to be the more regulated or the industries at risk of more regulation, which would be telecom, technology, and pharmaceuticals because of drug pricing. Okay, and then the final scenario, and I think it's interesting, I did put that this was the most negative scenario for markets. But I will say recently, and since I published this, there has been kind of a reckoning or a rethinking that maybe a blue wave isn't so bad, because at least you'd have a unified Congress and you'd get something done on stimulus, and not this impasse that we're in, which is really damaging to the economy. So, I still think probably the net reaction would be negative. I don't think it would be a disaster, though, because of this offset of a bigger stimulus package could be around $3 trillion, $3.5 trillion. And certainly for 2021, that would go a long way in providing a tailwind for risk assets. And then in terms of winners and losers, I think the sectors that would benefit would be part of Biden's policy, which is a infrastructure package, which would include renewables. Transport would do well in that kind of environment. Obviously, there'd be tons of construction, and you'd need trucks and materials for that. Insurance companies, because ACA would become Biden Care, and so you'd have expanded insurance and bigger volumes of people getting insurance, municipal bonds as well. And small caps, which may be a surprise to some, I put small caps there because with the taxes that are being proposed, those would largely affect large cap multinational companies because there are two taxes. There's an alternative minimum tax, and then there's a tax on foreign earnings. So any company that earns a large share of their revenues abroad would be subject to this tax. For that reason, I think small caps could be a winner. And then the losers are going to be those industries that are most vulnerable to greater regulation. Banks, that would be a particularly sore spot if Elizabeth Warren becomes Treasury Secretary. Pharmaceuticals, because of price controls. Energy, clearly a Biden, a blue wave would be moving toward net emissions free by 2050. Technology, because of regulation, telecom, and defense. We would take the administration would take a more multilateral approach. So, those are my thoughts. It's a lot on one page. Hopefully it's helpful. But I would just say that, the good news is that a lot of the risks on the election are out there already, about a contested election, about mail-in ballots, about, all the things that people have been worried about. And in fact, the options market is pricing in very high volatility during this period. So I think, more the question is, what are the markets not thinking about? And those are things that it's the unexpected. It's not the known unknowns, so to speak.
It's funny you should say that. That tees up my next question pretty well. So, are there any risks that people should be focusing on that by and large they're not? When you think about the election and some of the implications there, is there anything that you could point to? I mean, you mentioned like there are some things that are clearly in the public consciousness right now, including a contested election. But is there something maybe that's not on the radar as much that probably should be at this point?
Yeah, so I jotted a few things down that I think probably is not on the minds of market participants. And I think certainly kind of the post-election and post-inauguration period, which is who is in the administration? If Biden wins, and who does he pick for Treasury Secretary? On the list are some current or former Fed governors. I think that would be calming for the markets. But again, an Elizabeth Warren would be a lightning rod for certainly financials. So that's one thing. The other thing is, and in a note that I wrote, is about the Senate filibuster. So currently, most decisions in the Senate have to be decided by a 2/3 majority. If in a blue wave, the Democrats got rid of the Senate filibuster, it would mean that it would really pave the way for more progressive policy. So I think that's something very important to watch to see what the moves are in that scenario. And then another one that I've been thinking about and discussing with some of the political experts at Wellington and other investors is, again, in a Biden win, what happens? I mean, there are two scenarios. One is the election is very close, and I still think a contested election would be a negative. It would be a downside scenario, even though, as you say, it's in the public's consciousness, but just the fact that the path toward resolution is very unclear, I still think that would be a negative for markets. The last one, and I hope we don't end on this negative note, but I'll put it out there, is that what happens in the lame duck session with a Biden victory? So suppose, even if you have a landslide victory, and you still have Trump and the Trump administration between Election Day and Inauguration Day. What happens in that period? And, you know, that's subject to your imagination. But certainly something could surprise the markets in that circumstance, that, you know, and uncertainty in that period, you know, concerns me. So that would be, you know, of unknown unknowns, that would be the one that I'm thinking about most. And I think, you know, it's hard to position a portfolio this way, but it's another reason, Chad, that I do think that, you know, not being over your skis and risk during this time is probably the right place to be.
Yeah, makes sense. And just, by the way, if anyone has any questions, you can type them in the little Q&A box there. We've gotten a couple already, and I'm really, instead of having a separate Q&A time, I'm interspersing questions as they come in. So feel free, if there's anything on your mind, you can type that in as we talk. Kind of nearing the end of some of the prepared portion here, Nanette. I think one question that did come in that I haven't asked you yet is, they said, how much longer do you speculate that the Fed will continue buying debt?
So I don't like the word speculate. So I'll just say that my expectation is that Fed will be buying debt for as long as the eye can see. I think they have to. Actually, if you show that World War II slide.
Mm-hmm.
Oh, you just passed it. Yep. All right. This is a picture of debt to GDP. And we're, as you can see, that's that dark blue line, we're almost at the same levels we were in World War II, when Treasury was printing money like crazy to fund the war effort. So look at interest rates during that 46 to 55 area. So 10-year Treasury rates were between 2 and 4%. And, you know, today rhymes with history. That was another time when Treasury and the Fed were coordinated. And the Treasury knew that to fund that debt, the Fed had to be buying it. And that is essentially what's happening today. The Federal Reserve is financing the debt. Whether you call that modern monetary theory or some other name, there is certainly an element of that. And the issue is that the government will not be able to afford to service that debt unless the Fed does continue to buy the debt. So I don't think that this is a great long-term solution, and you hope that growth will ultimately be able to exceed our debt, the accumulation of debt. But I think for the next few years, the Fed will be in the market suppressing rates.
Makes sense. And then there's another question. I guess I'll paraphrase it a little bit. We had a slide up here a few minutes ago around protectionism. There does seem to be this trend, certainly. I think it's fair to say on both sides of the aisle, toward more protectionist policies. So what kind of impact could that have? Or do you feel like it's already priced into the market? So what's, just generally speaking, what would you have to say about protectionism?
Yeah, there is, we have a geopolitical expert at our firm, Thomas Mucha, who talks about great competition. And the great competition is, it is between the US and China. And what this chart is showing is that regardless of the administration, Democrat or Republican, public opinion is unfavorable on China. It has a very unfavorable view, whether you're a Democrat or Republican. That is one topic that unifies the country. So I do think that protectionism is a secular change that we will continue to see. And I think, look, tariffs in 2018 and 19 have not resulted in the trade deficit narrowing. In fact, the trade deficit is wider with China now. So, the question is, how do you build in protectionism on intellectual property, on purchases of goods, et cetera? I think that what you are going to see is continued actions to protect our national security. And that umbrella will be very wide as to what constitutes national security, whether it's TikTok or Huawei and so I think we have to be prepared for continued action on that front. And it's not a matter of just economic impact, it's a matter of military impact. So the technological advances that China is making and that national security in the United States is so concerned about is because the technology is being used for military purposes. So that's why this has become a national security priority. And we should expect it to continue. From an investment perspective, I think that global trade was very good for growth. And this is another reason to think, to the extent that global trade is reduced, it creates inefficiencies in the economy. Wages are higher, supply chains are less efficient. So I think, again, it's another moderating factor for growth. And I think that, the United States and Russia and China are all going to be on alert for who gains ground, either militarily, economically. And so, that's going to be a part of the investment landscape for the next several years.
Got it. Okay, so I guess along those lines, just had another question come in. What percentage of a growth portfolio should be allocated to Asian markets? Maybe another question within that is, every portfolio has got to be customized to an individual situation, but are you a proponent of allocating specifically to, say, Asia as opposed to broadly internationally?
Right.
And if so, can you speak to that thought process, I guess?
Yeah, sure. So I really appreciate the question, because I'm debating that right now as to whether I should increase my recommendation to emerging markets. And the only reason being is that so much of the index is comprised of China. 40% is in China and 70% in Greater Asia. So I do think, again, looking over a 12-month time frame, because we always have to specify what investment horizon we're talking about. Mm-hmm. Over a 12-month time horizon, the reality is that China, it has an autocratic system. It's a dictatorship of sorts and a centralized government. And with those draconian measures, they handled COVID-19 forcefully and ultimately better than many parts of the world. I think there are cultural aspects to that too, and that's why Singapore, South Korea, Taiwan, all of them at least have done better when you look at hospitalizations now, cases, COVID cases. So you see that I'm tying the progression of the disease to economic fundamentals, and Asia has handled it better. So I think China and surrounding Asia is going to perform better than many developed countries. So I think an interesting allocation would be to have, I would have a dedicated allocation to Asia, actively managed to really look at the areas of the economy that are transforming, that are beneficiaries of COVID. Even in Asia, travel is coming back. So I think there are ways to get value-oriented trades in your portfolio that are not explicitly value. They're not, financials and energy, but they are in more cyclically oriented areas of the economy that are doing better. So I think that, obviously there's more risk in those regions, and there is risk of sanctions too. But I would certainly, have a small percentage of my portfolio dedicated to Asia.
This international discussion is getting some traction. We have another question along these lines. This will actually be the last question because I do want to be respectful to everyone's time. So this person's asking, what are your thoughts on the NATO EU bloc as a trading partner, whether strengthening as a bloc with the US, especially versus China and or Russia? You want me to say that again?
Such
or
a
you got
deep question. No,
Yeah.
I think I get it. Yeah. So I'm working on a project right now, which is about institutions weakening, and that would include NATO, it would include the WTO. I do think that it's a little that institutions will be stronger with a multilateral approach to defense, diplomacy, trade, all these issues. So, I would expect that institutions, will strengthen. And I do think that would be with a Biden presidency, because he would take a multilateral approach. He would, embrace agreements with the EU. There would be more fortification against China, against Russia, with that multilateral approach. So that's my base case view. Trump has taken a much more unilateral view. I'm not critical of all his policies at all. I do think that the toughness on China was overdue, and he took a stand there. But from here on in, I think it would depend on a multilateral approach to these institutions, and that would strengthen democracies, ultimately create less political volatility, and be better for markets ultimately.
Great. All right. I think we may have to wrap it up. So I know we could keep going for sure, but I appreciate it, Nanette. Mark, do you want to say a few words?
Sure. I just want to say, Nanette, how impressed I was with your presentation. Nothing you said scared me too much. In fact, you were very level-headed. And our thoughts in many, many ways are aligned with yours. So, and we didn't pick you because of that. We picked you because of who you are and where you work. So I know that our clients appreciate what you've done, how you spoke to us today, and your message, and by and large, very positive. And I appreciate you, Chad, for putting all this together. And it's a lot of work, but our pleasure. And thank you very much to all of you for attending and for your business and trust with us. Have a great day.
Thanks, everyone.
Thank you. Thanks, Mark
Okay.
and Chad. Great to work with you.
Thank you.
You.